20-day cycle, and then it is going down. That's what the 80-day cycle is doing. What is the 20-week cycle doing? The 20-week cycle is presented on the chart as it has been, as it is forecast to play out. But in fact, because the 80-day cycle stretched slightly, we would say that that is causing the market to go up until the midpoint, which is the 80-day trough, and then it will cause prices to move down. Okay. That peak, as a matter of interest, is displaced because of something called time translation, which I won't get to talk about today, but we must talk about it in one of our traders' chats. But just in case any of you are wondering, why is that peak displaced? It's something called time translation. Okay, so I said to you that when we're trading the 40-day cycle, we need to consider the two cycles longer. The two cycles longer are the 80-day cycle and the 20-week cycle. How do we consider them? Well, we simply add up their influence on price. When they are influencing price positively, as the 80-day cycle is here, we add 1. When they're influencing price downwards, as the 80-day cycle is doing over here, we subtract 1. Same thing with the 20-week cycle. We add 1 when the cycle is moving up, and we subtract 1 when the cycle is moving down. Okay, let me just quickly draw in a squeezed, I haven't done this very clearly, but that's a squeezed 80-day trough. Remember that the troughs of the 80-day and the 20-week must be synchronized. They will be synchronized. So therefore, the troughs always occur at the same places. So I've done rather a squashed drawing here. But I hope there you can see the 80 days going up and down. Then what we do is we add up those numbers. So during this cycle of the 40-week cycle, the influence of the longer cycles, which is called the underlying trend, and because we're only considering 2 cycles, we call it the short underlying trend. The full or long underlying trend would consider many more cycles. But the short underlying trend, which is mentioned very often in Sentient Trader, and I'll show you in a moment how you can actually plot it on your chart, the short underlying trend is the summation of the influence of the 2 longer cycles. So we add those up. That's what summation means. We take the 80-day, so over the course of this 40-week cycle, from the 14th of March until early May, the shorter underlying trend was +1 from the 80-day cycle because it's going up, and +1 from the 20-week cycle because that's also going up. There it is. So therefore, when you add them up, you get a number of +2. Okay. Now let's have a look at this 40-day cycle from May until late June. What's the 80-day cycle doing during this period? Well, let me draw a vertical line there so we can have a look at what we're talking about. Well, the 80-day cycle is coming down. So that's -1. And the 20-week cycle, which has been distorted, as I was mentioning earlier, here's the line that I drew correctly, is going up. So we have +1 from the 20-week cycle, +1 from the 20-week cycle, -1 from the 80-day cycle, ends up with a short underlying trend of 0, or neutral. Okay. Let's have a look at this cycle over here, this 40-day cycle, which has not completed yet. We don't know where the trough is, but it's happening sometime soon. According to this analysis, and the underlying trend of the influence of the 80-day cycle is +1, okay, and the influence of the 20-week cycle is -1. There it is. So +1 -1 gives us a short underlying trend of 0. Okay, also a neutral underlying trend. Now, you can see that the software is expecting. Let me draw the inverted pyramid. Is expecting the 40-day trough to occur somewhere over here. And then the next 40-day trough will be occurring somewhere over here. So there is a cycle that's expected to complete over here. There it is in the semicircles. Okay, there's that trough. And you will notice that the underlying trend of the 80-day cycle, very easy to visualize given the semicircles, is -1. And the 20-week cycle, which is of course also coming down, is also -1. Let me draw that above there, the 20-week cycle. So therefore, the underlying trend here is -2. Okay, if that all sounded very complicated, let me clear my whiteboard and put on. This works. When you have harmonic ratios that are as they are in this nominal model, you will always get short underlying trends of +2, 0, 0, -2. That's how it works. Okay? Now I'm going to jump several chapters in the cycles course and say, what does this all mean? Okay, I started off by saying we're trading the 40-day cycle, we're trading the cycle over here. What does it all mean? When you have a short underlying trend, which is the influence of the longer cycles, which is positive, in other words, +2, that means that the long of the cycle are likely to be extended, and the short legs are likely to be very short, and therefore not profitable. Okay, when you have a positive underlying trend, you want to take long trades. You want to be bullish. You want to be buying, not selling. So let's have a look at the price. Here's a long trade. We would want to take that trade according to Hurst's methodology. We would not take the short trade that followed it, which was an unremarkable trade. Anyway, here's another long trade, and then here's the short trade that followed it, also very unremarkable. As you can see, when the underlying trend is positive, the long trades are profitable. The short trades are not. So Hurst advocated that when the underlying trend, in other words, the cycles longer than your trading cycle, are supporting the movement of the cycle, so in this case they are +2, in other words, they're bullish, they're causing price to go up, you take only long trades, not short trades. All right? Let's have a look at this cycle here. When you have a neutral underlying trend, Hurst said it's pretty much a coin toss in terms of which legs are going to prove to be better to trade, and the way in which you would answer that question is by looking at even longer cycles. But let's not get complicated now. Let's just keep looking at these. As you can see, here we had a long trade, which was a bit miserable, really. Here we had a short trade. Here we had, which was also a bit miserable. Here we had a long trade, and here we had quite a good short trade. That's the kind of thing that you expect from a neutral underlying trend. You expect very mixed results from a neutral underlying trend. Here is our next cycle. According to this current analysis, please remember, we have a long trade, which is good. We have a short trade, which is sort of mixed. We have a long trade, which is sort of mixed, disappointing. And we have a short trade, which is really good. So again, fairly mixed results, often the result of a neutral zero underlying trend. So what this is all boiling down to is, what are we going to do next? According to this analysis, the market is, of course, coming down into a trough of the 40-day cycle. There's that inverted pyramid. What's going to happen next is that we're going to have a 40-day cycle. Here it is here, which is going to come down to a trough of the 20-week cycle. The underlying trend of that is -2. When the underlying trend is -2, we expect to make money out of downward trades, short trades, not upward trades. Upward trades we make money out of during a positive underlying trend. Short trades we make money out of during a downward underlying trend, a negative underlying trend. And you get mixed responses in the neutral situation. Now, for those of you who know about sentient trading, and of course all our current users are exploring the sentient trading methodology, then you will know that the sentient trading matrix is all about deciding which of these 4 trades you take under different underlying circumstances. So if you decided to take long and short trades during a neutral underlying trend, then according to sentient trading methodology, you would in fact take all 4 of those trades. But that's just a little digression. I'm focusing on Hurst's original trading methodology. I will attend to some questions in a moment. Let me turn this off and talk about what's happening here. So I have just performed an analysis and let's see what the software says about the current trading. You go to View, Show, Analysis Summary Panel, and go to the Trading tab, and you will notice that it says here, let's see, it says all kinds of information, which I won't read out. It's all quite complex. But as a result of all its decisions, you'll see that it is trying to determine whether in fact it should take a long trade, and it has decided not to because the profit to risk ratio was not adequate. Why is the profit to risk ratio not adequate? If we have a look at our FLD pattern boxes, here we go. You'll see that the software is saying that the trough is coming into a 40-day, the price is coming into a 40-day trough over here. It's right bang in the middle of it. It's looking like a perfect projection. And price is going to move up to this point over here, the high 1200s. That move is not very impressive, and the software does not want to trade it. Why is that move not impressive? Because the underlying trend is negative. The underlying trend is causing this box to be pushed down in terms of the projections. And with an underlying trend, we do not want to be taking a long trade. Okay. So let me do a few things here so that we can see a bit of action, and I can actually force the software to take a trade even though the projection is not very good. Let me do that. That requires me to turn on Sentient trading. The reason for that is because Sentient trading allows you much finer control over the trading that's performed. The decisions are still made on the basis purely of Hurst trading methodology. So let me perform a completely fresh analysis and produce some fresh trades. And in the meantime, let me quickly have a look at. There are two questions I know. First one from Chris. When doing a trade matrix, does it depend on the cycle you're trading? If so, do you have to test every cycle for maximum profitability? Chris, yes. The answer to that is the trading matrix does depend on the cycle that you're trading. Although what you will tend to find is that all cycles at all degrees of a particular instrument tend to exhibit very, very similar properties. Those very similar properties, by similar properties I mean they have the same profit potential and the same sort of statistics all the way down. The reason for that is actually not really a surprise. The reason for that is because of the mathematics of it. Hurst's cyclic principle states that troughs are synchronized, and in fact what we're looking at is a big fractal. So what's happening on the really bigger picture also happens on the much smaller picture. So to some extent you should possibly look at adjusting your trading matrix for each cycle, but generally all the cycles of a particular instrument tend to exhibit similar properties, which means that the same matrix applied to different cycles often proves to be very effective. Okay. I think I mentioned before, it's worth repeating, we are doing extensive research into the sentient properties of cycles in stocks and currencies and lots of stuff. We have